So over the course of global financial history, there are generally these structures, these international agreements that form about how international trade is going to occur. It doesn't just tend to be anarchy with individual countries having their own relationships. There tends to be some sort of global structure in place based on the leading powers at the time kind of influencing the direction of that. And so prior to 1944, that was mostly based on the gold standard, where central banks around the world had gold in their vaults. They issued paper against the gold. And the UK's currency was the global reserve currency, meaning it was the most widely held and accepted, but really it was the underlying gold that was the actual kind of true reserve currency. But of course, as you had a period of economic growth in the United States through World War One, and then the post-war period, and then especially during World War Two, the United States became kind of the leading superpower at that time. They were the least damaged by the war. They emerged very powerful from it. They had a very large industrial base. And in addition, a lot of the gold was transported to the United States by allies in order to protect it during the war. And the United States also confiscated gold from its own citizens. And so the combination of their own gold and being a custodian for gold for other countries put them in a pretty privileged position. And so in 1944, the countries got together as the war was kind of in sight of ending. It wasn't over yet, but it was kind of going in that direction. And they were remarking on how to order the global system. And there were two competing ideas. One was the Bancor idea, is that basically there'd be a neutral currency unit based on gold or based on a basket of currencies, and they would use that as a unit of account globally. And the alternative idea put forth by the United States was that the dollar would be at the center of it. That basically that the dollar would be backed by gold, other currencies would back themselves by the dollar, and the dollar would be the global unit of account. And that second option is what won out. And so from 1944 up through 1971, we had the Bretton Woods system, which was that all currencies were pegged to the dollar, dollars pegged to gold, and we had this kind of fixed exchange rate situation. The flaw with that, of course, is that the United States was issuing more and more treasuries, more and more dollars, while it was not accumulating more gold. And in fact, because of gold redemption by international participants, so Americans could not own gold and they couldn't redeem the dollar for gold, but international creditors could. And so the United States gold kept dropping. Our gold reserves, even though our amount of dollars and treasures outstanding were increasing. And so when you got into the late 60s, that system started to break down. And by 1971, essentially enough European countries started to call the bluff and ask for redemption that Nixon and the United States severed that gold redeemability. And from there on, the currencies of the world have been all fiat currencies, meaning they're not really pegged to any commodity, any fixed amount. However, in the mid 70s, they were trying to salvage this system, especially because the United States oil production peaked and they had to rely more on imports, I mean, of that oil from the Middle East and elsewhere. And so the United States made a deal with Saudi Arabia and other OPEC countries in the mid 70s to only price their oil in dollars. So whether they're selling the oil to the United States or to Europe or to Japan, whatever the case may be, they only sell it in dollars. And in exchange, the United States would provide them with protection and trade deals our basically our ability to protect global supply chains, protect their sovereignty, give them favorable trade deals. And all they have to do in return is only price their oil in dollars and then also use those dollars to buy some of our treasuries and hold those in reserves. And what that did was it made it so that any country in the world that wants to import oil needs dollars. And so for about 50 years now, 45, 50 years, we've been in a situation where the dollar is not officially pegged to oil or officially pegged to any commodity, but it's kind of artificially pegged to oil in the sense that any country in the world that needs oil needs dollars to get that oil. And so that's been the situation we've been in for a while. But that's starting to break down in the past couple of years that maybe we can get into later in the interview. If you look at a long-term chart of the dollar, it's had these three really big cycles since the early 70s. We've been on this like free exchange system, and so the first kind of period where it's pretty like inexpensive, and we saw Latin American countries in particular load up on a lot of dollar-based debts to grow their economies. But then the United States dollar began strengthening in the mid 80s compared to a lot of other currencies, especially emerging market currencies. And so, from those countries' perspective, they ran into a problem where because you have a company in those regions, a lot of their revenues are denominated in their local currencies, and a lot of their liabilities are denominated in dollars. And so, if the dollar strengthens markedly compared to their local currency, they have a problem.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
And it kind of becomes like self-reinforcing, because the stronger a dollar gets, the harder it becomes for them to get dollars, and so they run into actual default risk, either companies or governments themselves. And so you had a big major Latin American economic crisis during that time, and the United States made deals with Japan and other countries to actually weaken the dollar. Basically, the United States the dollar got so strong the United States was harmed by it, because if the whole world slows down, if our trading partners start crashing, and if our economics become our exports become particularly uncompetitive, that starts coming back and hurting American corporate profit growth. And so the United States made a deal to reduce the dollar strength, and so that helped kind of alleviate that crisis. So we had a weaker dollar period. But then as we had the tech boom in the mid 90s, we ran into another one of those cycles where Asia in particular, Southeast Asia, was growing very quickly, right? So you had Thailand, Malaysia, South Korea, Singapore. A lot of these countries were growing very, very quickly. And they didn't have much dollar reserves, but they had a lot of dollar-based debts. We also had Russia coming out of the Soviet Union, right? So we had, they started acquiring debts. And so in the late 90s, you had the Asian financial crisis, which was essentially a dollar crisis, similar to the 1980s Latin American crisis, where a lot of their currencies were devalued. It kind of started in Thailand, but it spread rapidly. And so that resulted in a global slowdown. Eventually we had the peak in the dot-com bubble. But then as we got over that, the United States dollar began declining. We ran into a recession, slower growth. We had a weaker dollar period. And then again, that next weaker dollar period in the early 2000s was very good again for emerging markets. And so we started to see this time a little bit more globally diversified rise of nations. So we saw it was quoted the BRICS, Brazil, Russia, India, China were the big ones. We saw a very good decade for emerging markets. You actually had an emerging market bubble going into 2007. We had very, very high valuations in China, India, and to a lesser extent, Brazil and other countries. But that, of course, eventually ran into the global financial crisis, all sorts of problems. And as the dollar began strengthening, especially in 2015, 2016, you started to see a lot of pain in emerging markets. And so we've seen, commodities in a bear market. We've seen Brazil have a very rough economic time. We've seen, Russia, India, and China have held up better, but they haven't really been booming in the way that they were in that decade. And so we've been in this kind of sluggish environment. Then you saw a number of countries started to face the same kind of crisis problem that the Latin America in the 80s or Asia in the 1990s, in the sense that Argentina took out a lot of sovereign U.S. based debt, and so they've been unable to deal with that. So they're experiencing near hyperinflation. It's not quite hyperinflation, but it's a very inflationary environment. Same thing with Turkey, with the difference being that Turkey's debt is mostly in their corporate sector, right? So they don't really have a lot of sovereign debt. It's in their corporate sector, U.S. based debt. And so both those countries are low on dollars in their reserves, but high in dollars in terms of debts, which is a big problem for emerging markets. We've also seen issues in Lebanon, issues to some extent in Chile. It kind of, there's a spectrum between these countries and how much problems they have. And so we are starting to see, populism here at the United States because we've hollowed out our manufacturing base. But then you also see populism in many other developing countries because they're being squeezed by the dollar. And then a kind of a separate problem is you also see rising populism in Europe, because you have kind of similar dynamics playing out because of the euro and some of the imbalances that causes. And so we're kind of this is a pretty critical decade for the way that these currencies work, because really this whole system is kind of causing more problems than it solves at this point.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members, where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.